Welcome to This Is Money podcast. I'm Georgie Frost, and joining me today is editor Simon Lambert. And coming up, interest rates rise by the largest amount in decades. Why has the Bank of England done it, and what does it mean for your money? Despite rising rates, savers are still losing out, so what can you do? Also today, stealth tax hikes are on the way. They sound so much more palatable than a tax hike, but it's often worse, warned Simon. Plus, gas prices are down. Will our energy bills fall? And should you consider investing in a VCT? Don't forget you stay up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app.
Market updates and conversations around the financial world don't have to be boring. The Digest and Invest podcast by eToro is a great way to tune into what's happening in a fun and easily digestible format. Discover the Digest and Invest podcast at etoro.com/academy/podcasts.
But first, the Bank of England has upped the base rate from 2.25% to 3% as it continues to try to bring inflation in line. The 0.75 percentage point rise is the biggest base rate hike since October 1989, and it's the eighth consecutive rate hike since December 2021, leading to significant rises in our mortgage rates and savings rates. So, Simon, firstly, not a massive surprise, was it? Why have they done it?
Not a massive surprise. It was pretty much baked in, the 0.75 percentage point rise, although there was some talk that they could go for only 0.5%. They have chosen to follow the Fed, which did 0.75 percentage points yesterday as well, although actually the Bank of England MPC will have voted by that point. I'm pretty sure that the decision was already in. We just didn't know it. But it is a curious situation because we have the Bank of England delivering its largest rate hike since 1989. And it's also worth noting that in terms of how much of an impact this has compared to where the base rate is, this is actually considerably bigger because back then rates went up by 1.13%. from 13.75% to 14.88%. But that is obviously a smaller proportion of the number that they started with back then than going from 2.25% to 3%. So it's pretty big. Yet, what did the Bank of England tell us? It told us that it's raising rates by this much. We're going to get a very long and painful recession, that inflation is going to fall as of the middle of next year. And it's not just going to fall, it's going to drop below its target and remain below its target for some time. Meanwhile, in the press conference after the rate decision, we had Andrew Bailey and his colleagues discussing the state of the economy, discussing what the government may or may not do. And he said that we just work on what has been said. We don't work on what we think has been said, but admitted that whilst the energy price guarantee, which was going to be in place until April, was going to help households out a lot, that help is now going to be withdrawn, as far as we know, in some form. It's not going to be as good as it was. At the same point, acknowledging that interest rates on mortgages have gone up by a huge amount since the last rate decision came in. Yet we're seeing this big rise, and also acknowledging actually the pain that people are going to feel from this recession and the mortgage rate rises and the inflation and all those other things. Yet we're seeing this big rise. So some people might quite rightly question what on earth is going on.
Right. Yeah. What is going on, Simon? And what is worse, recession or high inflation?
That's a really good question, Georgie. And I think most people would probably initially gut reaction say recession. We know those are bad. We don't like those. But I guess in financial terms and in the terms of running an economy, inflation and inflation getting embedded is the worst of the two evils, certainly from the central banker's point of view, and especially inflation getting embedded at 10%. And that's really what they're at and what they're up to, because what they're doing at the moment has no impact whatsoever on the inflation rate that we see now. right? The 10.1% that we're at, that was the most recent inflation figure. And that's going to go up. It's going to peak because we've got the increase in energy bills that came, even though we had the energy price guarantee, that did involve the price cap going up to £2,500 for the average household. We've got petrol and diesel prices going back up as well. We've got food price inflation, which is rampant at the moment. All of those things are going to send the inflation peak higher than inflation is now. It's most likely that's going to happen. But changing the base rate now doesn't make any difference to that. That stuff's in the past. That's the price of stuff now compared to the price of stuff a year ago. What the Bank of England is trying to do is it's trying to stop people baking those inflation expectations into their thinking and what they're doing. It doesn't want people demanding a 10% pay rise. It doesn't want companies giving people a 10% pay rise. It doesn't want companies putting up their prices because they think that they're going to face higher prices in the future. It doesn't want all of these things that would mean that in a year's time, inflation is still 10%. It wants people to start thinking that there's less spare money going around. They can't afford to be giving people those pay rises. They should be worried about asking for those pay rises. They can't afford to put their prices up, that the prices of the stuff that they're having to pay for in order to run their business are going to stop going up at such a rate. It wants all those things to happen so that we don't have a 10% inflation rate just rolling on and rolling on and rolling on, because I don't need to explain why 10% inflation now and then 10% inflation in a year's time is really bad for the purchasing power of our pocket, because 10% on top of 10%, once you start compounding 10%, you get quite high quite easily. But I mean, central banks are faced with this scenario where they're making these moves and the inflation that they're tackling is largely coming from outside forces, as the Bank of England quite openly discussed today.
So, Simon, what does all this mean for our money?
This is where it gets really difficult to unpick, because ordinarily we'd be talking about mortgages and savings. We'd be saying your mortgage rate's going to go up. If you're on a standard variable rate, it's probably going to go up by as much as the Bank of England has raised by. If you're on a Bank of England base rate tracker, so your rate tracks the Bank of England base rate, it will go up automatically by as much. If you're on a fixed rate, you'll be protected for now. But when you come to remortgage, you're going to be paying more. But we've been thrown into a bit of a muddle by the events of the past. Where are we now? 6 weeks, 7 weeks? I don't know. It's flown by. We've been having so much fun.
Haven't we just?
It's just flown by. Because mortgage rates, in terms of the fixed rates that are on offer to people, have raced well ahead of the base rate. The base rate hasn't moved since mid-September. The decision was delayed because of the Queen dying, the national period of mourning. And that decision then came in, and the bank raised by 0.5 percentage points. And we'd already seen a bit of upward movement in mortgage rates anyway, because that was widely expected and so on. But then we've seen a massive jump in them, triggered by the mini budget, which I'm sure people don't need a big introduction to, but Kwasi Kwarteng and Liz Truss's ill-fated mini budget involved a tax-cutting bonanza that was unfunded, i.e. we were going to pay through it through issuing lots more debt, although we were going to grow the economy to help cover the costs. And that sent markets into a tailspin, caused a vicious circle in the pension market where pension funds were forced to panic sell bonds in order to meet demands on them that then forced them to panic sell more bonds. Mortgage lenders pulled mortgages left, right and centre. It led to what has been termed an aggressive repricing, which in normal person's language is mortgage rates going through the roof. And so actually, you could see a scenario where mortgage rates in terms of new fixed rate mortgages don't really move up at all off the back of this bumper rise in the base rate, because it's already been priced in and then some. And in fact, actually, we've seen mortgage rates come down a little bit over the past week or so. If you are on a standard variable rate, your lender is likely to put up the standard variable rate, but lenders haven't been putting them up by as much as the base rate has been rising, because standard variable rates were already pretty high compared to the base rate. And it had, in fact, moved up in the years where we had rock bottom base rates without base rate moving. So some lenders are soaking it up a bit on the standard variable rates. Some are raising by the amount, but they might put it up by a bit less. On a tracker, you're definitely going to see your mortgage costs go up. Savers, again, we'd be saying, well, you know what, your bank or building society will pass some of this on, but not all of it. Again, even savings rates have managed to race ahead of the base rate. It shows you what a topsy-turvy world we're in, doesn't it? So how much will we see savings rates move up off the back of this? Possibly not that much, because actually we're up to 2.5. We were on 2.75% for the best easy access rate, and fixed rates on 1 year, 4.5%. Those are much, much higher than they were before. But this is basically going to be felt in the months to come and over the next year, where people face a major squeeze on their finances if they've got a mortgage. Anybody who has to remortgage now or in the next year, or maybe even the year after that, is going to feel some real pain. And depending on what happens to interest rates, I think people are going to have to adjust to their mortgages being substantially more expensive than they expected them to be.
After all this and reading what the Bank of England have said, how high are we now predicting rates could go? There were talk of 6%, then it went to 5%, then it was 4.75%. What are we expecting and by when?
Right. So we had a very interesting press conference, actually, after the rate decision today, as I mentioned earlier, in which the bank admitted that things are moving so fast that stuff in its report is not right. So essentially, it works on market forecasts for interest rates. Now, I nearly said Mark Carney there. That's a blast from the past. Andrew Bailey was very keen to point out that the bank does not just follow market forecasts, and it will diverge from them when it needs to. It's got its own mind, thank you very much, and it will choose when it's going to put up rates and by how much. But it does use market forecasts for all the modelling that comes in the report. The market forecasts it used were for the 7 working days to the 25th of October. And that had the base rate peaking at about 5.2%, which was already lower than 3 weeks earlier. That's actually come down now, and market forecasts have base rate peaking at about 4.75%. And we've had economists coming out today saying they actually think it could be 4.5% now, some even saying just above 4%. It remains to be seen. I mean, it obviously depends on whether inflation does start to drop, like the Bank of England says. And there was a really interesting comment in the rate announcement and an interesting chart in the Bank of England report, which showed that even if it just kept rates at 3%, i.e. where they are now, inflation wouldn't drop quite as quickly, but it would still drop and would still then end up below target. Now, that's been taken by some as the clearest indication of the Bank of England signalling that we are, rates aren't going as high as people think. I tell you what, though, you look at that Bank of England bank rate chart and it going straight up in the air, looks a bit Bitcoiny. Like when Bitcoin goes straight up in the air, a bubble goes straight up in the air. Quite often what happens after that is it comes straight back down. And I don't know whether that will actually happen with interest rates. But I tell you what, central banks, they owe a generation of homeowners and borrowers a massive apology, because they have spent the last decade telling people that when rates go up, it would be gently and gradually. And they haven't. They have rocketed up, and there are people out there facing £500 a month more on their mortgage, and that's going to cause a lot of people genuine hardship.
Unbelievably so. And in this context of the cost of living crisis, when everything is going up, but what could they have done? What should they have done better?
I don't know. It's a good question. There's a question as to whether monetary policy, which is a very blunt instrument, is bumping up against the limits of how it can successfully operate. What we're seeing here is the unwinding of the super cheap interest rates era, I think. We're certainly seeing rates go up substantially, way higher than people thought. Inflation, way higher than people thought. Central banks doing quantitative tightening, the Bank of England, for example, selling back some of those bonds. We definitely seem to have seen a major change in the mood music. That's been combined, obviously, with the disruption of COVID, the Ukraine war, all that kind of stuff. But we are seeing a very, very complicated scenario where central banks have the unenviable task of trying to tackle inflation that they absolutely know is being triggered by, a lot of it's being triggered by Russia's invasion of Ukraine and the sanctions off the back of that and all the problems off the back of that. What on earth is raising interest rates in the UK going to do to help that? Absolutely nothing whatsoever. What's it going to do to help with the fact that China still insists on locking down a city, or Disneyland because there was one case of COVID and things like that? What's it going to do with what's it got to do with the wild swings in supply chains, or even the bit where not so long ago that ship got stuck in the canal and nobody could get a load of stuff? Raising interest rates makes no difference to that stuff, but it's the only tool they've got, and they are charged with getting inflation back down to 2%, to try and get it at the 2% target. That is the job of the Monetary Policy Committee, that and financial stability, but the inflation bit comes first. So they're using what they've got, but there are questions as to whether what they've got and what they're using is the right tool for the job, I guess. I mean, I don't know what the answer is, and how you do this, but I do think that after years of groupthink of keeping rates too low for too long, there does appear to be an element of gung-ho groupthink of just like whack them up, whack them up, whack them up.
Indeed, it does. Right, Simon, despite rising rates, though, let's talk about savers, because that's something we're going to be talking about, I imagine, for a long time yet. But savers still losing out, not all to do with insults accounts, is it, Simon? But the reason the Bank of England is raising rates at the moment, that is, of course, inflation. How bad is it for savers? I mean, it's getting better, isn't it? Why are we feeling sorry for savers again?
Well, is it getting better? Were you better off when the 1 year fixed rate account that you put your money into paid you 2% and inflation was at 1%, or now when that 1 year fixed rate account pays you 4.5%, but inflation is at 10%? The answer is you were better off then. So you were better off having your money in the 2% account than the 4.5% account. In fact, you were better off even in the scenario where you had your money in the 2% account and inflation was 3%. So the problem is that this is, the real issue with inflation is that it eats into the spending power of our money. So even when we're earning what look like pretty decent rates on savings, as people are starting to now, they're actually losing money in real terms.
So what can you do about it?
Well, lose as little money as possible, I guess, is the answer to that. Minimize your losses. Get yourself off that legacy insult savings account that might still be paying you 0.1%. There's still a few lurkers out there that are paying 0.1, 0.2%, and get your money into the best possible account that you can get it into. That might not be the highest rate, because in order to get the highest rates, you have to lock your money away for 5 years. Is it worth locking your money away for 5 years for 5%? It's probably better than locking your money away for 5 years for 3%, which you used to be able to do. But arguably, if you've got money that you can lock away for that long, you should potentially consider investing it instead, because history has tended to show that the long-term returns from investing in the stock market are better than the long-term returns on cash. And that has been a situation that has been true when interest rates are higher and when interest rates are lower. But if you measure it over a short period of time, you might get caught out. So anybody who put their money in a year ago will have lost money on the stock market, whereas even if they just left it in a savings account earning no interest or 0.1%, they'd be better off. But once you start stretching that over a longer period of time. History tells us that the better return on your money comes from investing it. But if you want to keep it in savings, maybe you might just be better off taking a shorter term fix. Is it worth taking the 5-year fix to get the extra rate versus the 1-year fix? Now, obviously, you could take a 1-year fix and rates are lower in a year's time than they are now. That's the thing you have to watch out for. But I think the real answer to it is basically don't just sit there in legacy accounts that are earning nothing. Narrow that gap between your savings and inflation as much as possible. And if you struggle to keep track of all your savings accounts, it is worth considering something like a savings platform. Raisin, Hargreaves Lansdown Active Savings, AJ Bell has one. It's one called Flagstone. There's a number of these out there where you can manage all your savings in one place.
Is there going to be a sweet spot, Simon, where inflation falls and saving rates stay high? Because it does seem a little bit unfair that, of course, the savings rates are going up. Inflation is really high. And the reason they're going up is because the Bank of England is trying to bring inflation down. So is there a sweet spot to be had soon?
You'd like to think that at some point there would be, wouldn't you? A sweet spot where you were getting a real return on your savings, where your interest rate was higher than inflation.
Exactly.
Yeah, that'd be nice, wouldn't it? There's an entire generation of savers out there who have hardly known a combination of attractive sounding savings rates and a real return on their money. They have known at times a real return on their money where rates have been higher than inflation, but that's only because inflation has been bumping along the floor at just above 0% and their savings rates were still paying a deeply unattractive rate. It would be nice. I mean, there are people out there who go, well, look, inflation's at 10% and you need to have interest rates above inflation in order to control inflation. So we need to get interest rates to 11%, which should be wonderful for savers because they'd be getting a real return of 1%. I'm not so sure how great it would be for the wider economy.
That's it for part one.
I'm joined now by Ben Laidler from eToro for our weekly look at what's been going on the markets. Ben, the past week, it's been interest rates, hasn't it?
Yeah, it's been a big week all round. I mean, the FTSE 100 has had a great week. I mean, it's bucked this sell-off we've seen globally that came after the US Fed say they would keep hiking interest rates for longer than expected. UK stocks have really been helped by just continued strong third quarter profits. They're some of the strongest in the world. They were up about 65% versus last year, so big numbers. And many of these stocks are very international, and they've been helped by the weakness we've seen in the pound this week. We saw a jumbo UK interest rate hike from the Bank of England, but currency investors took some fright as the bank also warned that we're set for a long recession.
And what do we have to look forward to on the markets next week?
There's plenty going on. Outside of the UK, we've got the US midterm elections on Tuesday. We've got the latest US inflation report also. With the start of the COP27 UN Climate Summit. This is the one that was in Glasgow last year. We also have China Singles Day, which is the biggest shopping day of the year anywhere. Closer to home, we've got the latest GDP report on Friday, which is probably not going to be a pretty read, but hopefully just continued good earnings. We have the likes of Marks & Spencer, ITV, Persimmon, Wetherspoons. So hopefully they'll be able to keep the positive profits picture going that's really been driving the FTSE.
Okay, well, thank you very much for that.
Thank you.
Welcome back. The Chancellor has a £50 billion financial black hole to fill. Will it come from direct tax rises, a cut in public spending, more windfall taxes, or something more subtle? Stealth tax hikes. And the biggie, of course, is the freezing of income tax thresholds. So as wages rise, more people are pulled into higher bands. Simon, this is the topic that you wrote about this week. What are stealth taxes? Why are they on your mind?
Stealth taxes. Here's a tree falling in the wood question. Is it a stealth tax if you tell everyone about it?
Well, it depends. Do people understand it properly and how it's going to impact them? If they don't understand it properly, no. Well, there you go. That's a stealth tax. Yeah.
Then it's
you
a
can tell
stealth
people
tax,
how to go,
isn't it?
You don't get it, though.
It is true, isn't it? Because if you go back to the tax cutting bonanza that was the mini budget, Kwasi Kwarteng shot himself in the foot catastrophically by gathering the most attention for his cut to the 45p tax rate, which was going to be abolished and reduced to 40p. He could The prize that he could have won was everyone paying lots of attention to his cut in basic rate income tax from 20p to 19p, which is one that everyone gets. But he decided that, you know, it's not just enough to pull one rabbit out of the hat. You've got to put a whole, what do you call a collection of rabbits?
No idea. I
No,
knew you were going to ask me that. I'll Google it while you talk.
You have to pull a whole collection of rabbits out. So anyway, he did that. But the thresholds, income tax thresholds, were frozen. And what people forget is that that has the ability to take more money off you than the money that you were getting. So, for example, a cut in the basic rate of income tax puts an extra penny of each pound earned in a basic rate taxpayer's pocket, which is good. But if you freeze the thresholds at which the tax rates kick in, it can, not always, but it can take more back from their pay rises. So if you don't raise the personal allowance in line with inflation, or pay, whichever one you want to choose, but let's go with pay, for example, you pull more people's earnings into the basic rate of tax. And so they pay an extra 20% on an extra pound earned. The easiest way to understand that is for someone who's right on the threshold of the personal allowance, and then they earn an extra pound, and from that pound, they then get 20% tax taken out of it. The one that gets talked about a lot, and actually the one where we've seen a huge amount of fiscal drag, which is where you drag more people into higher rates of tax by not moving the brackets, is the 40% threshold for higher rate tax. So if you don't raise that, then people lose 40% on any extra earnings, albeit they would have had 20% taken off it. So they're only losing an extra 20% than they were. They're not losing an extra 40%. And just to put it into context in terms of the maths, right? Someone gets a 5% pay rise, which is the current average according to most recent ONS figures. If they're right on the higher rate tax threshold at £50,270, they get a 5% pay rise, they'll see their salary go up by £2,315. Now, if the higher rate tax threshold goes up 5% in line with average wages, they get to only pay 20% tax on that sum. So they pay £503 worth of tax. But if the threshold is frozen and doesn't go up with wages, their entire pay goes into the 40% bracket, and they'll hand over £1,005 or £1,006, twice as much. And that's the difference between keeping £2,010 of their pay rise or keeping just 1,508. And that's how it works. And the longer you do this for, the more of people's money it drags in. And you have to remember that a lot of people's pay only really goes up by inflation plus a teeny tiny amount. I mean, and sometimes it doesn't even match inflation. There's not many people getting inflation matching pay rises at the moment. So that's why you should raise the thresholds, because actually they should at least go up with inflation, because otherwise people are losing money. If it goes up with inflation, you're steady, the threshold is steady, and you're not losing out to the rising cost of living. If it doesn't go up by inflation, you're losing out to the rising cost of living. And the silver lining here is that the personal allowance has gone up in real terms over the past 12 years, since 2010. It's climbed from £6,475 in 2010 to £12,570 now. So that's actually more than CPI inflation. Had it only risen in line with CPI inflation, it would be at 8,961, which shows that it has gone up quite a bit more than that. But that does also illustrate that although it seems quite generous how much the personal allowance has gone up by, 41% of that is just accounted for by the rising cost of living since 2010. But the real stealth tax trick that's been going on is with the 40p tax rate. Now, if that had risen in line with inflation, it started at £43,875 in 2010. It would have gone up now to £60,724, but it's not there. It's at £50,270. So that is a huge gap, £10,000 gap, basically, in how much that threshold should have gone up. And you can see why chancellors like this fiscal drag wheeze, can't you? And then finally, we come to my pet peeve in the tax system, the ridiculously unfair bits where all of a sudden you see the effective tax rate spike due to bonkers bits of the tax code. First bit, removal of child benefit for parents, for households where either parent earns above £50,000. You can have two parents earning £99,000 between them. They get to keep all their child benefit. But if one of them earns more than 50, it starts getting taken off them until they get to 60,000. That delivers an effective marginal income tax rate of 51% if they have one child, or 59% if they have two. Also, the removal of the personal allowance above £100,000. That creates a 60% marginal tax rate. Neither of those thresholds have moved at all since they were brought in. And if the child benefit one had gone up with inflation, it would be at 62,500 now. And if the personal allowance one had gone up with inflation, it would be at 142,000. Now, I realise it's very difficult, as I've said before, to garner sympathy for people earning more than £100,000.
There is no government right now that's going to ever do that for those people earning over £100,000 after the mini budget fiasco.
No, there isn't. And that's actually one of the, we were talking about this earlier, myself and Tanya, and saying that that's one of the worst things about the mini budget fiasco is actually there's loads of stuff that should be done that won't be done now. And this stuff it is it, right? If you are going to continue with this mad removal of child benefit thing, where this, you know, the one parent versus the two parents thing is just completely crazy. But if you are going to continue to go with it, then you should be raising that threshold in line with inflation, arguably, or wages, whatever, but at least with inflation. And again, the 60% tax rate on people, because they pay that between 100 grand and 125 grand, and then their effective tax rate goes down to 40%, and then it goes back up to 45% after 150 grand. But there's no way that people getting £250,000 should be paying less tax on the next pound they earn, on the next extra pound they earn, than people earning £100,000. That's just completely wrong. And you need to make your tax system fair so that as people rise through it and earn more and more money, they think they're being treated fairly, and they continue to be willing to hand over the money. And every little thing that you do to people as they go through it, and let's face it, the people who earn the most money do pay the most tax, right? By quite a long way. Everything you do encourages them to just go, right, well, I'm going to try and dodge this if I can, or do that, or whatever, you know. So anyway, fiscal drag. It doesn't sound like much fun.
It drags.
It isn't.
Right, some rare good news. Let's do, well, it's not really. It's never really good news, is it? But look, I mean, among the gloom and doom and the economic gloom and doom, wholesale gas prices have dropped from their summer peak. So that means our energy bills are going to start falling, doesn't it, Simon? Doesn't it? It's good news.
It's great news. Well, we were all watching this one with interest after sensible teacher Jeremy Hunt stole our energy price guarantee, which, you know, was a slightly crazy idea, and it was going to cost the country loads of money. But we had just got used to the fact that at least, well, I was going to say we didn't have to worry about our energy bills. We had to worry about our energy bills less for the next 2 years than we thought we were going to. And let's face it, the energy bills that we're paying now are already more than double what they were. But no, that got ripped up. So it's only going to last till April. And then the help is going to be more targeted. And we, as we said, when that was announced, we know what targeted means, don't we? It means we ain't getting it.
Yeah.
But the good news is that gas prices are falling. And actually quite substantially. So spot prices, day ahead prices, currently around 45p a therm, right? A significant drop from the 550 high in the middle of summer. So Europe has been refilling its gas storage and refilling it at pace in order to try to get it through the winter without relying on Russian gas. And the price was driven up dramatically as Vladimir Putin did some saber rattling on gas. There's been some urgent maintenance that needed to go on the Nord Stream pipeline. And it's just maintenance. It's not trying to starve Europe of gas or anything like that. And there's been some unfortunate accidents involving undersea bits of it. And, you know, let's not get into the geopolitics of all of this, but, you know, the gas supply has been weaponized and the price obviously went up. after the invasion of Ukraine and has been very high. It had then fallen a bit, and then it went up because Europe was desperately trying to fill up its storage to get through the winter. But they did a good job, actually. They got quite a lot of stuff in storage, and then we had a unseasonably mild October, and we've had some windy weather, which obviously helps with wind generation and stuff. It's, in fact, the weather has, up until this week, when it appears to have entered monsoon season, the weather has been quite sunny as well. So all this stuff helps with pushing down the energy prices. But what we've seen is sort of spot prices come down. Those are the prices for if you want buy energy and then you want it tomorrow. But energy suppliers don't operate on spot prices. They buy their energy well in advance. They fix their prices. The ones that didn't do this, a lot of them went bust in the shakeout from the initial energy price spike. So our energy providers aren't in a position that they can just go, right, here's some cheap power and we're just going to cut your prices. Now, the hope is that if this effect continues, maybe, just maybe, we might get down towards that energy price guarantee level. But as it stands, you know, the experts are saying that if it was left to the open market at the moment, that energy price guarantee of £2,500 would be closer to £4,000. And it's likely to, yeah. So the retail price is lower than the wholesale price, basically. But we need that wholesale price to stay down.
Without being daft, Simon, you know, the average energy bill, which is sort of £2,500, do they factor in that it would be different given the season?
How,
Because you're going to
when
use
they're setting
less...
the energy price cap?
Well, yeah, it's like, do they...
Well,
when they say it's the average price of an average household sort of thing, I mean, is that what averagely we're going to be using?
Yeah.
Or paying for, even though in April we're probably not going to have the heating on and that sort of thing, it's still going to be
yeah,
£4,000.
they work it out really on unit costs. So it's basic. So this is some people complain about this, that we talk about this average household cost when every household uses different amounts.
Yeah.
It confuses people, and some people think that they're just going to pay £2,500 and from that point on they're not going to have to pay any more. That's not the case. Just in case anybody listening to this thinks that's the case, that's not the case. And also that we should talk about units and the price of units. But it's quite difficult, the price of units. You don't know the price of units. I mean, how many units does it take to boil a kettle? How many units does it take to use the microwave? We talked about doing the maths on a couple of podcasts back. So anybody wants to know, go back a couple of podcasts and we explain it to you. But you do know what your bill is roughly per year. If you're on a direct debit, it should be divided up equally. So you just multiply that out to get it over the year. And when they set the energy price cap, they look at what the average energy household use is, and they work it out on that. Not, you know, it's April and the next 6 months, therefore it should be cheaper.
Finally, Simon, there's a 50% VCT tax break Hunt and Sunak haven't axed. It's high risk, but investing in fast-growing startups can reap big rewards. So should you get involved? Firstly, what are VCTs?
Venture capital trusts. They are a way of investing into a company, a type of investment trust, which has shares in itself, a listed company that then invests into other companies. Smaller, often referred to as startups. They're not really startups. They're more kind of scale-ups. They're more companies that are already established, but have some kind of opportunity for really fast growth. And the rules have been changed so that they are targeting more of these smaller, dynamic, fast-growing companies. It used to be that VCTs could be used for things like investing in doctors' surgeries and reaping dividends from that. It's not possible now for new money that the VCTs are investing with that. But the idea is that investors pull their money into these trusts, and their money goes into providing capital to these small, fast-growing, future success companies. And when those companies are a success, perhaps they get bought out by another company, perhaps they list on the stock market, perhaps they stay private for some time. and hand money back to some of their investors. They have funding rounds and so on, that investors can then kind of take some of the returns. But what comes with investing in small, dynamic, scale-up, startup companies is a high failure rate. Lots of these companies will not do well. Lots of them will not survive. The idea is that it's a portfolio approach, and the ones that do well will do so well that those gains will massively outweigh the losses from the others. But because people are taking a substantial risk with their money, and things may not go their way, there's a large tax break that's attached to VCTs to try and encourage people to do this and to put their money in, and then also to think long term, so that it means that your money has to be in there for a certain period of time in order to get those returns.
So, Simon, should you invest? And if you do, what do you need to think about then? Finally.
Well, the first thing you need to think about before you decide to invest is whether a VCT is right for you. They are typically something that are invested in by wealthier people, higher net worth, people with larger amounts of money to invest. And ultimately, that is because they are higher risk. And also because they bring this healthy tax break, which is really good for people who are higher earners, for example, and have their pension contributions limited and things like that. So what you get with a VCT is you can claim up to 30% upfront income tax relief on the amount you invest in a new VCT or in new shares issued by an existing VCT. But you have to keep those shares for at least 5 years. The maximum investment per tax year is £200,000. The maximum you can put into an ISA in 1 year is £20,000. So that tells you a bit about the people who are investing in these things, doesn't it? For example, invest £10,000 in a VCT, £3,000 could be taken off your income tax bill. And then if you sell your VCT shares and make a profit, the proceeds will not be liable for capital gains tax. But again, you have to hold on to them for that period of time. And a lot of the return from VCTs comes from dividends paid out from them rather than from the share price of that VCT going up. With a normal investment trust, you would expect a lot of the returns to come from the dividends that you get, but also from the share price of that trust going up. So take Scottish Mortgage, for example, which invests into disruptive, high growth companies, many of them listed, but also invest into private companies as well. Scottish Mortgage, most of the returns from that have come from the share price going up over time. Pays a very small dividend, share price has gone up. With the VCT, a lot of the money comes from dividends. The other thing to think about with VCTs is that it's a world that's not known to lots of people, and you need to do your research carefully. As with any investment, it may be a very good idea to seek some financial advice with these. You don't have to, but it might be a very good idea. And also watch out for the costs as well, because fund fees on VCTs tend to be pretty high, often 2 to 3%. And there could be an initial charge.
Goodness.
And there may be places that you can invest into them with a lower initial charge than others.
All right, then, that's it for this week. Thank you very much, Simon. You can keep up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app. And if you have any comments or questions for the team or anything you'd like them to look into, Simon?
You can email us at editor@thisismoney.co.uk. You can tweet us at thisismoney or come to thisismoney.co.uk/podcast to find all podcast paths and join in the debate and read the comments.
And if you like our podcast, why not rate us wherever you found us? It helps other people find us too.
Market updates and conversations around the financial world don't have to be boring. The Digest and Invest podcast by eToro is a great way to tune into what's happening in a fun and easily digestible format. Discover the Digest and Invest podcast at etoro.com/academy/podcasts.